Okay, well, hi everyone, and welcome to Small Business Lending 101, when borrowing makes sense and when it doesn't, presented by Vyde and NEWITY. We are so excited to have you here with us today. My name is Shakria Hall, and I'll be your host. We also have Danielle Wagner, who's joining us today, who's another Vyde team member, but she's off camera, providing us with some much needed tech support in the background. And last but not least, we have our subject matter expert and our very special guest speaker joining us. We have Alex Detweiler, who is the VP of Credit and Underwriting at NEWITY. And he's coming to us. Daniel, if you go to the next slide, please, we can have our headshots and the bios there for us. So here we are. So Alex is coming to us with over 10 years of experience in financial services and consulting. And Alex's focus is on making loan programs user-friendly for both borrowers and internal teams. So Alex, thank you again for joining us. And before we move on and get into the content, did you have anything that you want to add about yourself or what the attendees can expect from you today?
I think that covers it. Excited to be here. Appreciate the Vyde team for having me, and let's do it.
Perfect. Okay, so if we go to the next slide, we'll just go over a quick disclaimer. So while we hope that you'll find this discussion helpful, the session is for informational purposes only and is not intended to be legal or tax advice. And if we go to the next screen, you'll see our safe harbor policy. So please take a moment to review that as I go through some additional housekeeping items. So we're recording today's event, and just in case you wanted to review the content again or maybe share with a friend, and you'll receive that around this time tomorrow. So be on the lookout for that via email. And today's discussion is meant to be very casual and conversational. So although we'll leave about 15 minutes at the end for your questions, if during the presentation you have a question about the content, just feel free to drop them in the Q&A section, and we'll try our best to address them as we go along. And if we run out of time, we'll follow up with you via email. So as you can see on your screen right now, we have today's agenda. And I'll leave this up so you can quickly review it, but we have first up, the topic is when borrowing makes sense and when it may not. Then we'll go into some common eligibility criteria, the different types of business credit, how to compare financing options, and then SBA lending basics, and again, the Q&A that I mentioned earlier. We'll leave a few minutes at the end to go over those. So if we go to, and then one other thing. So at the end, throughout the presentation, we'll have a few poll questions. So they're very short, and they'll help us better understand your needs as attendees and where you might be in your entrepreneurship journey, and some things that you might need as a business owner. And the survey at the end is really to help us understand your satisfaction with today's presentation. So we really hope that you'll take some time to answer the questions for us so we can better assess the upcoming webinars and conversations that we might schedule for you all. So if we go to the next slide, you'll see the first of the 3 poll questions, and this will really set the stage for today's discussion. So tell us, what aspect of business funding or business lending feels the most confusing? Is it A, knowing whether you qualify, B, understanding your loan options, C, comparing costs and repayment terms, or D, determining whether borrowing is the right move? So please use the Zoom poll window to answer, and we'll give you a minute or two to respond before we get started. Okay, Danielle, where are we with the responses? Are we about ready to select to show the responses, or do we need a couple more minutes?
Yeah, it looks like answers are starting to slow down. So we'll go ahead and share poll results.
Okay. Oh, wow, this is a good mix. This is a good mix. So if it's knowing, wow, so we're kind of tied with knowing whether you qualify and understanding loan options. Wow, these are all pretty equal. So, but the top 3 will be determining if it's the right move, understanding your loan options, and knowing whether you qualify. So Alex, does that help you understand or know where to spend the most time today, or?
Yeah, frankly, it really does. And it kind of speaks to small business lending in general, where it's not one or the other. Every single one of these is an important aspect um, of the process. So I think it makes complete sense that there's a pretty even split there.
Yeah, yeah. Well, awesome. Thank you again for responding to those questions. And we'll get into the first topic, when borrowing makes sense and when it doesn't. Alex, I'll pass over to you.
Amazing. Well, thanks, Shakriya. And again, thanks to everyone who weighed in on that first poll. It's a good place for me to pick up because it points at the question that we deal with every single day at NEWITY and in this industry in general. So just a little bit more about me. I lead our small business loan teams here at NEWITY. In plain terms, it means my team looks at businesses and tries to answer the question, does borrowing actually make this business stronger, or does it just add weight to the business? So that's where I want to start today. Not with how to borrow, which we will get to, but when to borrow. Because the smartest thing that you can do with financing is to know the difference between a loan that is going to push you forward and a loan that will hold you back, because we do see quite a bit of the latter these days. Danielle, if we can go to the next slide, please. Thank you. So here's the theme for this whole slide. Borrowing tends to be a smart move when it supports growth and there's a clear path to paying it back. So let's walk through these situations where borrowing typically makes the most positive impact. Having one of these is great, having multiple is even better. So the first one is the most straightforward. You are ready to expand. The demand is already there. You've got customers you're turning away, or a specific location that's overwhelmed in a good way. This is when looking at debt capital does its best work. It lets you meet the demand you can already see instead of hoping that it's just going to show up later. Second up, the investment earns more than it costs. This is probably the heart of all of this. It's the test that I'd love every owner to run before they sign anything. If you borrow money at a given rate and that money lets you generate more profit than the cost of the loan, that's a good trade in a vacuum. The loan pays for itself and then some. If it doesn't clear that bar, you are losing money on that transaction. So third, you are bridging cash flow that's delayed. I mean, verified timing-based gaps. And the classic example here is a seasonal business. So picture a retailer who makes most of their revenue in the fourth quarter holiday season, but still has to buy inventory in the summer to prepare. Based on your operating history, you know that the revenue is more than likely coming, although it's never certain. It's just coming later than the bills. Financing can smooth that out. The key word here is verified. Verified revenue, it's coming later. You can point to last year's numbers and the year before. You're not borrowing on a hunch. So fourth up, we've got consolidating high interest debt. If you've got balances scattered across cards and short-term borrowing at painful rates, rolling them up into a single loan at a better rate can lower your payments, improve your cash flow, simplify your life so you're not making multiple payments every single month and having to remember those. You're not adding debt, you're just reorganizing it into something cheaper and easier to manage. Fifth, we've got funding, marketing, and advertising. When you have evidence that it works, this is the key here. If you know that $1 of advertising reliably brings back more than $1 in sales, financing that spend can accelerate your growth. The caution is the same as before. It should be marketing that you can measure, not just throwing ads against the wall to see what sticks. And then sixth, supporting hiring and workforce development. Bringing on staff, training the team that you have. Both of those can unlock capacity that you can't reach otherwise. And when that new capacity generates more than it costs, borrowing to get there can make real sense. Okay, so what ties all 6 of these together? The pattern is that in every single one of them, the money is going towards something that creates value and you can see how you'll pay it back. Those are 2 things that are tied together and super important to remember. Okay, next slide, please. All right, when borrowing doesn't make sense, the other side of the coin. And this is a part a lot of lenders, advisors, brokers, etc. skip. So let's be clear here. There are situations where borrowing adds far more risk than value. As somebody who works in this industry, I always come into the situation wanting to do a loan for somebody, but part of being responsible in this industry is knowing when it will not make sense for a business owner. So the first red flag, repayment relies on projections, not current cash flow. There's a big difference between the money is coming, here's the history that shows it, and the money will come once all this works out. If the only way the loan gets repaid is a future that hasn't happened yet, or is very uncertain, very unlikely, you're making a bet on something that isn't verified. And debt can be very unforgiving, or an unforgiving way to place a bet, because the payment is due whether the plan works or not. There's always going to be some level of uncertainty in these outcomes, but that's where you need to have a sense of, is the outcome that makes this financing successful a 10% probability, 40%, 95%, and then base your decision on how likely that outcome is to happen. Second, you're using the loan to fund owner draws or personal expenses. I understand why it happens. The business and your life are tangled together, especially early on, just as you're trying to get started out. But borrowing to pay yourself doesn't create anything the business can use to repay the loan. It just moves a personal cash flow problem onto the business balance sheet, usually with interest attached. This kind of goes along with the thing that I always tell people I work with, which is from the start, make sure that you have bank accounts separated between personal expenses and business expenses. If I jump into an account or look at bank statements and I see personal expenses and business expenses commingled, you may have those expenses very organized and perfectly figured out. But to somebody who works in this industry, it looks disorganized, and it makes somebody think twice about whether to lend to that person. Third, and this is one I feel very strongly about because it requires you as the business owner to be extremely self-aware and take a critical look at your business. You are using the capital to fix a structural problem. So what does that mean? Basically, if the business is losing money because of something fundamental, your pricing is wrong, your costs are too high, the business model just doesn't quite work, a loan doesn't fix that. It funds the problem for a little bit longer. Borrowing against a structural problem usually makes the eventual reckoning bigger, not smaller. So the recommendation is there is fix the leak first, then look at borrowing to grow. And then lastly, the loan term is mismatched to the use. This is about matching the length of the loan to the life of the thing that you are buying. If you finance a long-term asset, a piece of equipment that you'll use for 10 years, with short-term financing that's due in 12 months, you've built a cash crunch into your own plan. So as a rule of thumb, short-term needs pair with short-term financing, long-term investments pair with longer terms. So quick summary of these two slides. Borrowing isn't good or bad on its own. It's a tool. The same loan that's brilliant for a growing shop is dangerous for a struggling one. The difference is what you're using it for and whether the cash to repay it is verifiable. So this brings up a fair question. When you go to a lender, what are they actually looking at? Let's get into that. Next slide.
Before we go into some of these eligibility criteria, Alex, I wanted to ask you a couple questions, mainly because of our customer base, like what we know about our attendees. But first, thank you so much about mentioning the importance of separating the personal from the business accounts and banking. That is really important, and it's something that we at Vyde promote very early in our customer journey because it also helps with creating clean books and helps with bookkeeping and tax preparation and all those things, right? And so that's right in line with the messaging that we deliver to our customers. So thank you for that. But also considering the journey that our customers are in, a lot of them are just getting started, right? So they're just getting started, they're newer businesses, and sometimes they might not have some of the things that you're looking for in their journey, like some of the guarantees about revenue and things like that. They don't have that quite yet. So for someone who isn't ready for a loan, what would you recommend they focus on over the next 6 to 12 months to prepare themselves for a loan?
Yeah, it's It's organization and preparation and just knowing what we'll get into here essentially, but knowing what we will be looking at as somebody who's trying to give financing, so you're organized when you're ready to apply. That's number one. Number two is just knowing your options beforehand. So, a lot of times we get asked how do I know when it's time to apply?
Mm-hmm.
My recommendation there is, and make sure that people aren't doing hard pulls on your credit, so you're not applying 10 places with hard pulls and ruining your credit score, but just apply. Then you'll have a better sense of what people are looking for, what the process looks like, how long it takes. Because if you're waiting to jump into this process until you need the money, you desperately need it to grow, to hire somebody new, whatever it is, you're already behind because you don't know, is this going to take 24 hours, a week, a month, something like that. And that's where people get pushed into more of those predatory options that, hey, I need this money in 24 hours, so I have to take whatever option is presented to me, rather than, okay, I know what 10 options are out there, I know how long it's going to take, and I know what I might qualify for, and just being more thoughtful about that.
That makes sense. And then we have a question from Jasmine Gray. Thank you for submitting this, Jasmine. And she's asking, what about borrowing for startups?
Mm-hmm. Yeah, so different options are going to have different requirements here. For example, a business credit card, if you're a startup, it's a great option because you don't need to have that long operating history. For something like an SBA, Small Business Administration loan, there are options for startups out there. I'd recommend that people go out and look at the SBA's lender match tool that you can enter in your business's information, what your potential use of proceeds would be, all of that stuff, and then it will match you with potential lenders based on that information. I think that's always a helpful exercise. But for startups, it's hard because you don't necessarily have any of those things like long operating history, evidence of revenue, profitability, things like that. So you are going to be a bit more limited in your options. There are options out there for term loans, SBA loans for startups, things like that. But this is where you have to be smart, because the last thing you want to do as you're getting started out is get yourself locked into something that the business can't handle right from the jump.
Okay, well, thank you. We can, Danielle, if we go to the next slide, we can get into the rest of the content.
All right. So typically, and I never want to say always because it depends on the type of financing and the lender you're working with, but no single number decides eligibility. First off, credit history. Yes, we look at credit, both the business's credit and, for most small businesses, the owner or owner's personal credit as well. That's one input. What it tells us is how you've handled, repaying your obligations in the past. Next one is cash flow. It's a big topic of conversation in the industry right now, with the number of lenders out there that look at bank statements and are able to pull out, what the borrower's most recent history looks like in terms of cash flow. And what lenders care most about is whether the business generates enough cash to comfortably make the loan payments. Sounds pretty self-explanatory. In our world, we call that debt service coverage. And all that means is a simple comparison. For every dollar of loan payment that you owe, how many dollars of cash flow do you have to cover it? You want a cushion there so that one hiccup doesn't sink the ship. A piece of debt service coverage, obviously, then would be existing debt. So what type, how much, how recently it was originated, all of that provides a picture of the business's stability and whether it can handle additional financing. Time in business is another one. We just talked about startups a little bit, but how long you've been operating and the overall trajectory of the business is a big deal, frankly. A longer track record gives the lender more history to lean on. Newer businesses can still absolutely qualify. It just means the other parts of the picture, especially cash flow, collateral, industry experience, will carry a bit more weight, and you may have a tougher time accessing certain types of financing. Couple others that I'll highlight that aren't on here. Collateral, this is an asset that can back the loan, so equipment, real estate, and so on. Collateral lowers the lender's risk because there's something behind the loan if things go sideways. Not every loan requires it, and the role it plays varies a lot by loan type and size. So industry is one that I mentioned. Different industries carry different risk profiles, different rhythms. So a seasonal business, a cash-heavy business, a service business, all look a little different on paper. And lenders take that context into account. It's rarely a yes or no factor on its own. But again, this all kind of wraps up into the overall calculus. And then use of funds. So circle back to where we started, what you are actually going to do with the money. A clear, growth-oriented use that has a visible path to repayment is far more compelling than just general working capital or, hey, I need the money to run my business with no specifics. When you can tell a lender exactly what the money's for, how it pays the lender back, that shows preparation and thoughtfulness on your part and goes to the organization aspect that I mentioned earlier. Best thing you can do coming in is to understand your own picture and be ready to speak to it honestly. I believe we actually have a question that speaks to that on the next slide.
So thank you for that. I did have one question before we get into the poll, and it's really quick because it is relevant. Danielle, can we go back to that previous slide really quickly? So what I wanted to highlight was more about the personal credit aspect. In our previous webinar that we had with Dunn and Bradstreet, we talked about the importance of building your business credit profile and how in the early stages of your business, there's a heavier reliance on personal credit that is weighted more heavily in the beginning because you don't have much business credit, at that time, right? And so you have to evaluate the likelihood of repayment, like you said, right? And so if someone doesn't have great credit or they have less than perfect credit, does that automatically take them out of the running, or do you evaluate certain other aspects of their business profile?
So most places you go, most options out there will have credit minimums. That's just kind of the way it works. Minimum thresholds that you need to exceed in order to potentially be eligible. There are other options out there that would rely more on cash flow of the business. For a startup, for example, there would be options out there that take the industry experience of the owner into account. Like, let's say you were the general manager of a restaurant for 20 years, decided to open up your own restaurant. That kind of experience will play well there. But again, this goes back to what I said about you have to understand the options that are out there, what's going to be possible for you, what's not going to be possible for you, far in advance of you actually needing this financing. Because otherwise, you come up against it, you have a cash flow crunch, and that's where people go to the more predatory, high interest, daily, weekly payment options.
Gotcha. Thank you. So yeah, Danielle, we can go to the next poll question. What best describes your current situation? Are you A, not currently considering borrowing and you're just really looking to get some information? Are you currently exploring your financing options? Or do you expect to need capital in the next 12 months? Which best describes your situation? If you can answer, we'll give you a second to answer, and then we'll move on to the rest of the presentation. Danielle, whenever you see the slowdown, just let us know and we can share the results.
Sounds great. Looks like we have 60% who voted so far.
Okay.
Go ahead and get in your responses before we close the poll. Okay. Here are the results.
Currently exploring financing options. And so awesome. So it sounds like the lending criteria and the rest of the presentation is right on track. Alex, I'll give it back to you.
Amazing. All right, we can go to the next slide, please. Okay, so let's talk about a couple of the most common tools that small businesses reach for when they need capital and the specific problems that each of these options solve. Because matching up, like we talked about, term and type of investment that you're doing with the type of financing is very important. Next slide, please. Thank you, Danielle. Okay, so choosing the right financing option. So before we go column by column on the next slide, let me give you the plain English version of each of these options. So a term loan is what most people picture when they hear loan. You'll borrow a set amount once upfront, you pay it back in regular installments over a fixed period of time. One lump sum in, steady payments out. A line of credit works more like a reserve that you can tap into. So you're approved for an upper limit and you draw on it when you need it, pay it down, and then you can continue drawing up to that limit. Here's a phrase that you will hear me use, a revolving balance. And all that means is the balance goes up and down as you borrow and repay over and over and over. The important part here is that you generally pay interest only on what you've actually drawn, not the whole limit. And then a business credit card, you already understand from everyday life. It's a revolving tool like the line of credit, but built for smaller, frequent day-to-day spending with more convenience and the tracking that comes with a card. So let's move to the next slide now, and we'll talk about matching these to real needs. So starting with the term loan, this is your tool for large planned investments, big deliberate moves. So think equipment purchases, an expansion project, renovation, significant one-time investment, essentially. The repayment is fixed monthly payments over a set term, so you know exactly what you owe and for how long. That predictability is obviously important. So here's an example. Say you run a shop and you're buying a $60,000 piece of equipment you'll use for years. A term loan lets you spread that cost over a period that roughly matches how long the equipment earns for you. You're not draining your cash flow to buy it outright, and you're not cramming a long-lived asset into a short-term repayment. All right, next up, the line of credit. This is your flexibility tool. It's for ongoing needs and the natural ups and downs of cash flow. So it's ideal for managing cash flow gaps, for seasonal or cyclical needs, for unexpected expenses, and for jumping on a growth opportunity when it appears. And because you pay interest only on what you draw, it can sit there quietly costing you little until you actually need it. So the difference there between a term loan and a line of credit potentially is a term loan, you're going to have to take that out and be making payments whether you're actually using the capital that you brought in or not. With a line of credit, it can sit there with, frankly, no balance and only then draw on it when you need it. So back to our seasonal retailer example for the line of credit, they don't need a big lump sum sitting in an account all year. They need breathing room during the slow months and the ability to pay it back when the busy season lands. And finally, the business credit card. This is your everyday tool. Recurring business expenses, travel and meals, office supplies, short-term purchases. It's a revolving balance you pay as you go. So it keeps the small, frequent stuff organized and separate from your personal spending, which we talked about earlier, which your bookkeeper and your future self at tax time will thank you for. Where it gets expensive is when a card becomes long-term financing for something that it was never meant to carry. Everyday spending, yes. Funding a major investment over years, probably not. So the quick mental model I would leave you with: term loan for the big planned purchase, line of credit for the flexible and the seasonal, card for the everyday. Obviously, those are not the only options out there. There are other tools, and it's worth knowing they exist. So let's head to the next slide and we can talk about those. Thank you, Danielle. So beyond those big three, here are a few other options you'll come across. Some of them fit within those earlier three buckets. Others are slightly different, but let's give a quick, honest read on each of these. So SBA loans, we'll spend more time on these in a few minutes. So just a quick blurb here. Loans that are made by approved lenders and backed in part by the government, often with some of the most favorable terms available to small businesses. Factoring agreements, otherwise known as invoice or accounts receivable financing. If you've delivered the work, but you're waiting on customers to pay, and this is relevant for some industries, not so much for others, this lets you borrow against those unpaid invoices to free up the cash now. For example, you might get paid 80% of those unpaid invoices in cash, so that you're not waiting on those to get collected. It solves a very specific problem that the money is owed to you, it's just not in your hands yet. But again, there's a cut that the factoring company would take off the top of that. Merchant cash advances, another one that's very very reported on in the industry right now. It's a big topic of interest for a lot of people. You will see these advertised heavily these days. An MCA gives you cash upfront in exchange for a slice of your future sales. It's extremely fast and easy to get. Sometimes you can get them same day, but that speed typically comes at a much, much higher effective cost than traditional financing. I'm not telling you never to use one. I'm telling you to read the agreement carefully, read the documentation carefully, and know the true cost before you sign. And frankly, that's not an MCA specific thing. That should be what you should be doing on any of these options. One more not on here that I want to go through would be equipment financing. So it's financing tied specifically to the equipment you're buying, where the equipment itself typically serves as the collateral. If your need is a specific machine, vehicle, this can be a clean fit. And then finally, equity raises. So this is not debt, obviously. This is somebody, a business, an individual coming in and saying, I will give you a certain amount of money for a certain percentage stake in your business. Typically, there are no monthly payments associated with that, but it does limit the upside and potentially the control that you have over your own business. Yeah, go ahead.
I had a quick question because I've never heard of factoring agreements. I've heard of the rest of them, but can you tell me more? Like, can you tell me how popular is that type of financing, and does it come typically with really high interest rates along with the MCAs? I'm kind of assuming that they both come with kind of high interest rates. I'll just say that.
Yeah, factoring agreements have been around for longer and are typically lower rates. They're typically used in industries where the collection of receivables has a longer tail. So if you're performing a service and then waiting 30 to 60 days for that money to come in, and you have to bridge cash flow gaps for payroll or for other projects, that's a good thing to weigh. The spreads on those factoring agreements can vary pretty wildly. So again, that's why you've got to read and understand these options before you decide to go with them, because a factoring agreement that takes 5% off the top is pretty different from something that takes 25-30% off the top. And I think there are places for both of those where they can be profitable for a business and a good fit, but you have to understand that for your specific situation.
Gotcha. Thank you.
All right. So the reason I run through these is so that when somebody pitches you on one, It's a friend, another business owner, somebody who works at one of these companies. You can place it, ask the right questions, and not get talked into the wrong tool. So that's a good lead in to one of the most useful skills that you can have as a borrower, which is just comparing the offers, comparing the options that you have. We can move to the next slide, please. All right, so evaluate the full picture before you sign. I love that that's the subheader here. It's very important because two offers can look very similar on the surface and be wildly different once you read them closely. So here's what to actually compare. First, the rate and the true cost behind the rate. Look past the headline interest rate to the APR, and better yet, the total cost of capital, which is the all-in dollar amount that you'll pay over the life of the financing. This matters because a low advertised rate with heavy fees can cost you more than a higher rate with no fees. Ask the question, by the time I paid this off, how many total dollars leave my business? Second up, because of the flexibility piece of this. So payment structure, frequency of payments, all that. Are the payments monthly, weekly, even daily? Do they take a fixed amount or a percentage of your sales? This is where offers differ in how they'll feel day to day. Daily or weekly withdrawals especially can strain cash flow far more than a predictable monthly payment, even at a similar cost on paper. Couple others that fit into these boxes: fees and prepayment penalties. That last one surprises some people. Like, some financing actually charges you for paying it off early. If you expect to pay ahead of schedule, a prepayment penalty can just erase the savings that you were counting on. Term length, how long do you have to repay the loan? Longer term means lower monthly payments, but usually more total interest. Shorter term is the reverse: higher payments, potentially less total cost. And neither is automatically better. It just depends on what you as a business owner can handle. And like I said, just run every single offer through these filters to try to get the full picture of what you're agreeing to. All right, next slide, please. Cool.
Okay, so I believe this is the last poll question. So if you apply for a business loan today, what would be your biggest obstacle? Do you think it's not enough revenue, limited business credit history? Is it personal credit concerns, or are you not sure? And then y'all just let us know when we're ready and we can get back to the presentation.
We're still getting some response coming in, so we'll leave it open for maybe another minute. But if you haven't had a chance to answer, please go ahead and answer. Okay, we'll go ahead and wrap up this poll. And here are the results.
Mixed bag again. Okay. All right. Well, now we'll kind of get into the last section, and it's all about SBA loans. So thank you so much for participating in this final poll, and I'll get into the rest of the presentation. Alex?
Great. So you may hear the term SBA loan thrown around a lot, and some of you may not even have heard about it at all. There's some confusion about what it actually is, including occasionally what the letters even stand for, frankly. So let's get it exactly right. If we can go to the next slide. All right, what is an SBA loan? An SBA loan is a loan issued by an approved lender, a bank or a lending partner, and it's backed in part by the U.S. Small Business Administration, which is a federal government agency. The government, to be clear, is not the one lending you the money, and the government is not guaranteeing the whole loan. What happens is that the SBA will provide the lender a partial guarantee, essentially a promise to cover a portion of the loan if it isn't repaid by the borrower and if the lender followed all SBA guidelines in originating the loan. We call that the SBA guarantee. So what does that actually do for you? Obviously, it takes some of the risk off the lender's shoulders, but the guarantee makes lenders more comfortable saying yes to loans and offering terms that might be harder to get otherwise. And it's why SBA loans are often one of the most affordable financing options available to many small businesses. But to be clear, backed by the government does not mean automatic. It doesn't mean free. There's still a real underwriting process, and you're still fully responsible for repaying the loan. But as I said, the important piece here is that the guarantee can allow the borrowers to access favorable terms that may otherwise have been non-starters for lenders. Next slide, please. Okay, so why businesses choose an SBA loan? Why do businesses seek these out? Lower down payments or no down payments is one. So SBA loans can reduce the amount of cash you need upfront. That matters because cash upfront is often the single biggest barrier to a big investment. You need financing. Putting down cash to get that financing is often a tough ask. Less down or no money down in many cases means you get to keep more of your working capital in the business. Longer repayment terms is another one. So payments can be spread out over more time, 10, 15, 25 years for some use cases, which improves your monthly cash flow. It's not a 6-month loan where the payment schedule is really accelerated. Remember the matching principle that we talked about earlier. So longer lived investments deserve longer terms. SBA structures tend to support that. Competitive interest rate is another one. So very often they're lower than conventional options and some of the best that you'll find in the market. And when you run the, does the investment earn more than it costs test from the start of today's session, lower cost of capital makes a lot more investments clear that bar. Higher borrowing amounts is another one. You can often access more capital, which opens up investments and growth options that smaller financing can't reach. Last couple here, flexible use of funds. In a lot of cases, the proceeds can go toward equipment, real estate, working capital, even acquiring another business and more. So instead of stitching together multiple different products for multiple different uses, you may be able to fund several needs through one loan. And finally, it's government backed. So we just covered this. The SBA guarantee reduces the lender's risk, and that's what makes this financing more accessible in the first place. All right, next slide, please. All right, and finally, a quick plug for what we do at NEWITY and how we can help. So NEWITY is a lender service provider that has supported more than 125,000 businesses. We've facilitated over $12 billion in capital to those small businesses, and our process runs on average about 3 times faster than the national average. The initial intake is only a 10-minute online application, and there's no hard credit pull. So, what I talked about before about exploring your options, applying to these options to see what will be required maybe down the line when you do need financing. Like I said, when the initial intake is only a 10-minute online application, it's a pretty low bar. A lot of business owners assume that the SBA path means mountains of paperwork, months of waiting before you even know where to stand. Our aim is to take that first step and make it simple. Again, 10 minutes online to get started and see where you fit. And whether it's through us at NEWITY, through a different provider, through different products, etc., I cannot recommend highly enough that you explore your options before it becomes a massive need. I mentioned this several times already. I want to just make sure I say it one more time. Apply for an SBA loan, a line of credit, a credit card, see what might be possible for your business and how long it may take to access the capital so that you aren't stuck taking a quick but unfavorable option when the need arises. The upside to that as well is, even if you do get declined for an SBA loan for a line of credit, any lender, facilitator, or firm in this industry that's worth their that's worth applying to will be able to tell you why you were declined so that you can actually work on taking steps to improve that before you apply again. And frankly, it gets back to reading your agreements, reading what you're signing before you sign it. People like me, people who are, working for these companies, if they cannot explain in plain terms the terms that you are signing so that you actually understand them, that's not somebody that you should be working with. Most of us in this industry are here to help our clients out, make sure that we're setting them up for success. So big red flag is when somebody can't actually explain to you what you're signing. All right, I'll get down off my soapbox. That's what I've got. So I'd love to get to any questions that we have.
Yeah,
Feel free to
thank
get to
you.
that.
Thank you, Alex. So we do have a few questions, and the first one that I wanted to address was because we have some of these newer business owners, just starting out their journey. What are the requirements in terms of time in business? Do you have any of that at NEWITY? So for people who've only been in business for a few months, what would you tell them for the requirements to apply?
Yeah, it's a good question. So the SBA defines a startup as any business that's been in business for less than 2 years. We currently do not work with startups, so we need to see that 2-year threshold in order to be eligible. But that's where the lender match tool that I talked about earlier, I think, is really powerful. It's through the SBA where you can access their system, say, okay, I've been in business for 3 months. This is the industry. This is what I'm looking for dollars wise, financing wise, and then what I'm using or looking to use the funds for, and then submit that request. It goes out to the SBA's network of lenders, and you'll receive a list of companies that may be interested in working with you within a couple days. And again, that's important because the SBA does set minimum requirements on these loans, but every lender service provider like ourselves, facilitator of loans, will have different requirements above and beyond that. So even though we're not currently working with businesses who have been around for less than 2 years, there are numerous firms out there that do work with those businesses.
Gotcha. Thank you. So essentially, if you haven't been around for 2 years or more, the best starting place would be the SBA website, and they will have some resources for you to match with a lender that potentially can help.
Yeah, agreed.
Awesome. We have a question from Latoya. She's asking if NEWITY offers lines of credit.
We currently do not. There are, again, SBA products out there that are government guaranteed in the same way. They function as lines of credit. They're relatively newer from the past year or 2 years that they've been launched. But again, those can be accessed through the SBA's lender match tool. So really a good option to explore everything that's out there. And we have plenty of business owners that come into our system that may not qualify for our process, but I always choose to do right by anybody who comes to us. And if somebody can't get financing through us but can through another firm, I will be right there celebrating with them.
Awesome. And then when you think about the various loan options, so either someone who's earlier in their journey or someone who's been around for 2 years or more, is there typically a good place to start when it comes to the loan types or the loan types, or does it just depend on the situation?
It always depends, and that's something that I have to say far too often, and people I think get tired of hearing me say, unfortunately. But the first place I would go, or another place I would go as well, is whatever bank you are working with for your business checking, business savings, whatever it is. They obviously already have your deposits, they manage your money. Typically that relationship will get you in the door more favorable terms on a potential line of credit, maybe even a term loan. So that is a good place to start. If you're working with whether it's a larger bank or one of the newer fintechs, exploring the potential options that you have through your own institution can be a good place to start.
Okay. And when it comes to SBA loans, just to take us back to that topic, I think you mentioned this earlier, but I wanted to bring it back up again. Do you hear any common misconceptions, or what are some common misconceptions you hear about SBA loans that you can share?
Yeah. Biggest one is just time and effort. There are a lot of requirements involved, which means that, this is not going to be a 24-hour process. But I think the one real upside to, starting a business in this day and age is that a lot of firms like ourselves are more tech enabled, making this stuff, these processes that, used to be you had to carry a paper application down to your bank. A loan officer would review it over the course of 4 weeks and then come back to you with more information. There's none of that anymore. So these processes are far more streamlined, far more easy on the borrowers. So time and effort is a big one. I think another one is that, you have to be somebody that can get a $1 million loan to make an SBA loan worth it. In the past, again, if you were carrying your paper application down to your local credit union to get an SBA loan, a $2 million loan would take the same amount of time as a $50,000 loan. And so banks didn't really want to do those smaller loans just because they take a lot of time, same amount of time as a larger loan, and they're just not profitable for those institutions. We actually at NEWITY focus solely on those smaller loans. So call it 0 up to 350,000, and trying to streamline that process so that even if you're call it a cafe that's been open for 2-3 years, and you're making $100,000 in revenue, $200,000 in revenue, you're not making millions and millions of dollars, you can still potentially qualify for one of those $25,000, $50,000, $70,000 loans that banks in the past, decade, 2 decades just wouldn't have any interest in doing. So that's another common misconception, is that if you go the SBA route, it has to be this giant loan. There are really, really good small loan programs and micro loan programs out there for those businesses that, are just your general Main Street small business.
Okay, thank you for that. And then our last question is, you mentioned the separating business from your personal accounts, right? How important the banking and the clean records were. And so I just wanted to ask a little bit more, dig into that a little bit more.
Sure.
And I wanted to ask you how having organized financial records and just an overall good understanding of your numbers might affect your lending process.
Yeah, it goes back to organization and preparation will make the process just so much more painless for everybody involved. And I think when people ask me what they can do ahead of time to make themselves look more favorable, the credit score stuff, the cash flow stuff is all fine. A lot of times it just comes down to organization, responsiveness to requests, and then a third one that I think doesn't get said often enough is just treating the people that you're working with the lender, whoever you're working with on the financing side, treating them like human beings, as we would treat our clients. It's financing can be stressful for everybody involved, but if you are organized with your documentation, you know your story, and you are responsive to requests, that's just going to move things along so much more quickly versus, you know, an incorrect document is submitted, it's reviewed, then somebody has to come back and request another one. Or if there are questions about your bank statements that you can't answer off the top of your head, anybody who is organized with their information and responsive is just going to come across as, you know, a borrower who's got their stuff together and who's going to be far more likely to, you know, be able to repay this loan long term.
That makes sense. And I'm sorry, I think I misspoke because that was not the last question. I have one more before we wrap up. And that's what are some common things that you ask for? So, you know, me and some of the other attendees aren't really familiar with the process, right? So what, outside of bank statements, maybe your personal credit report, what else do you ask for?
Yeah, so another, you know, positive of a lot of this being tech enabled now is that we're able to pull a lot of this stuff on our own. So credit reports we can pull, background checks that are required by the SBA, things like that. In general, across SBA loans, other options, because I want to be making sure that we're covering everything. Bank statements are the big one right now because they provide the most recent picture of what the business is spending, bringing in, all that stuff. Business tax returns are a big one. You know, if you are a newer business, obviously you may not have those yet, but if you've been in business for 2, 3, 5 years, you know, those tax returns start to show a trajectory of where the business is headed over time. That's a big one. Personal tax returns as well allows the lender to look into, okay, does this business owner potentially have other businesses out there that may be affecting their ability to repay certain loans? And then in terms of existing debt, just making sure that you have all that information centralized. Like, hey, I've got these 3 credit cards, I've got a line of credit, I've got a term loan. It's, you know, it was originated on this date, it has this monthly payment, all that stuff just is very, very helpful to have organized up front, just so that we have a full picture of current debt, and can, you know, just move on to the next item more quickly.
Thank you. Thank you so much, Alex. So that kind of brings us to the close of today's webinar. And we really hope that you enjoyed all the content and it was very useful for you. As I mentioned earlier, we will send out a recording of today's event tomorrow. So be on the lookout for that. And in addition to the recording, we'll have Alex, we'll have his contact information in case you have any questions for him. And we'll reach out to you. He'll reach out to you directly to, you know, to get some information over to you or get your application started if you're ready to get moving there. So thank you again for joining, and we'll see you at the next session.